Hello and welcome to the Valentine's Day version of the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Good morning, Ben.
Good morning, Will, and happy Valentine's Day to you as well. I
Yep.
made sure to call my girlfriend this morning. I hope you did as well.
I did. Yep. So I guess you guys don't have any special plans today specifically since you're in two
We
different states.
did we did Valentine's Day on Sunday, which turned out to be a really nice day because the Chiefs got the Super Bowl victory.
Yeah.
So it worked out great. It was a red alert, if you will, Valentine's Day and Chiefs victory.
There you go. It's hard to beat when you get a two positives in one day like
That's
that.
right.
So hopefully staying positive. What's the market outlook currently? What's the shift been from last week?
Yeah, prices largely up across the board. Old crop corn for March up 10 cents to 6.86. New crop corn up a penny to 5.96. Old crop soybeans for March up 11 cents to 15.37. New crop soybeans up 14 cents to 13.84. Soybean oil was relatively flat, but slightly up. Soybean meal, though, up almost another $14 per short ton to trade above $500 per short ton. That's, at least according to my records, Will, the third highest value on record. The last time we were at these levels for soybean meal, at least on the futures market, was all the way back in 2014. So a kind of a quiet rally, I guess, in that soybean meal market. That I say quiet. I think anybody that buys soybean meals, been watching this kind of just continue to creep up, but certainly higher prices there in the soybean meal complex. Old crop wheat up 39 cents to 7.88. New crop wheat up 36 cents to 8.01. And then that West Texas Intermediate crude oil up almost $5 per barrel to trade just under $80 on the week.
So we're seeing a lot of widespread support into the market over the past, week at least, if not more, for a lot of these other commodities too. So what's been really the main factor, really giving the market that support?
Sure. I could probably summarize this with war and weather, is probably the two biggest drivers here. We've got premiums built into the markets, but you correctly identified, we're seeing that spread in those old crop and new crop prices just continue to develop. That's a key point here. But ethanol production decreased 8 million gallons week over week to fall back below 300 million gallons. USDA cut their corn used for ethanol estimate 25 million bushels last week for their February estimates. That nearly matched my estimate of being short 26 million bushels. So basically right there. USDA's monthly supply and demand report last week were relatively as expected, with slight increases for domestic stocks, increasing across the board there on weaker domestic demand, and then also decreasing global corn and soybean supply on smaller Argentine and Ukraine production. As you just kind of go back last week, I told you I thought we'd see about a 3.5 million metric ton reduction in that Argentina corn crop. We saw a little bit bigger, so I didn't think they'd go that far. I still think they got more to go in March, but definitely decreased that a little bit. Ag export sales last week were again mixed and following a trend. Corn sales were elevated. Bean sales were, the second lowest value of the marketing year, and wheat sales were also relatively low. Mexico issued a new decree on Monday of this week, removing a requirement date for that ban on GMO corn, but signaled that they still, have a plan of eliminating GMO corn imports. And then they maintain that full-blown GMO ban on white corn. And then weekly soybean export inspections hit their lowest levels in 5 weeks, although they remain elevated from historical volumes. And then export inspections for corn continue to struggle. And that's been just a constant theme that we've seen all season so far.
So quite a few factors there, like you said, kind of setting the tone with trade, some production expectations, and several other things, obviously. So, but really today we're not talking about any of that. We've been talking about those topics the last several weeks. So if you want to know more about those, feel free to check out some of our previous episodes. But today we're going to talk about general grain marketing, which I think this is a good time to do it before we really enter this upcoming growing season, kind of a clean slate almost. So Ben, a couple of weeks ago, you presented at the Young Ag Professionals annual meeting here in Ohio, the Ohio Farm Bureau's hosted event. So really, what are some overview items first before we dive too deeply in this? Whenever farmers are trying to make a marketing plan that can really, get them through the year and get them out in a positive fashion.
Absolutely. So grain marketing is one of those things that largely is driven by emotion. And I always remind folks that sticking grain in the bin and just waiting to a higher price is in fact a plan, right? We always talk about have a plan, have a plan. And I think most of the time people, when they say that, are intention or like taking that as create something other than just sticking it in the bin and waiting. But that certainly is a plan. The reason I bring that up is I always encourage people to think intentionally about what they're doing, recognizing the risks that they face, regardless of what plan they choose, whether that's forward contracting, whether that's hedge to arrive contracts, whether that's sticking it in the bin and waiting, right? Being intentional about what risk face you is kind of my key message here, because they all have trade-offs, they all have pros and cons, and just recognizing what's out there for each one of them is very important to me.
Well, just talking about sticking it in the bin, one of the things that you talked about a couple weeks ago, which I thought was fairly interesting, was that sometimes that storage capacity can give people a false sense of time, that they have time to wait and hold, but sometimes that doesn't always turn out to be beneficial.
Yeah, so this is where the paralysis, or we get paralyzed in terms of doing something, really starts to come in. I always say that on-farm grain storage is a great investment, unless it is you're building on-farm storage just for your marketing plan. Then it creates this sense of hesitancy, maybe because there's always the thought that maybe corn and soybean prices, wheat might go higher, and therefore you don't do anything, right? This is where I always encourage producers to take what the market is giving you, and make decisions. Know what you're going to do. Again, it's back to that intentionality of knowing what you're going to do based on what the market is signaling. I'm an economist. I believe in market incentives, right? Right now, we have an inverted market in both corn and soybeans. What's that telling us? Well, that's telling us that the market's relatively tight, but that the futures market is also needing product now, and it's incentivizing production now, or supply coming into the market now, rather than waiting into the future, right? Certainly, when we get these pictures, that means the market could go higher because it's tight, and they need product now, and so in a month maybe they still need product, and it's even at a higher price, right? So it's not an indication that the market's going to trend down. It's just a signal of when the market needs the product. And certainly in inverted markets, there's very little incentive to stick it in the bin unhedged, as a way, right? Like, I mean, it's that's what the market's telling us. You're not gaining anything by sticking it into the bin, and so taking that as a signal to sell it across the scales. And if you want to rebuy that in paper, and calls, that's certainly an option. They are pricey at these points, but certainly that's a plan as well to consider.
Well, one of the things that you talked about, again, the farmers can really do to try and keep their marketing plan moving, is to create a calendar, have set dates, however often throughout the year, that you're looking to at least lock in some type of profit, keep things moving. So really, how can that help producers from getting too paralyzed and getting too stuck on waiting?
Yeah, so I do encourage decision dates and price targets, right? So like price and decision dates in combination, right? So if you hit your price target before your decision date, right, go ahead and sell. Some people would wait for the moving average to correct itself as a signal, right? So that's a technical strategy there. But certainly, have price targets and then have decision dates, because if you get into a scenario to where you're sitting there, I'll use soybeans for instance. Last month, right? It seemed like every time old crop soybeans got above $15, we just fell back down. They didn't like the air above $15, and that can create an incentive to say, okay, well, let's wait until it's consistently stays above $15, or looking out into new crop and thinking about what new crop soybeans, if it gets above $14 or something like that, what that would do. And that's where this hesitancy comes from. And so I always encourage decision dates. Dates that are easy to remember is my recommendation. To just, if you get to that point and you're making a profit at that price, go ahead and contract some bushels, lock in that profit and that premium, just to make sure that you're doing something, and not creating all this risk on unpriced grain later in the season.
Well, and on that, I feel like you hear all these anecdotes, at different conferences, talking to different farmers, and they're like, "Yeah, I had corn or soybeans waiting for me in the bin when the price was at a certain point that'd be very profitable." And then they're telling you, "Well, but I didn't sell," and you're like, "Well, why did you sell then?" And they're like, "Well, I was waiting for that plus another 5 cents." And that's the tough situation you get into, and layering that on top of the emotions of trying to, I guess, make the most out of your product, trying to be the best marketer possible. It can be tough. And whenever you look back on these long-term trends, it seems easy to kind of decipher looking back, obviously, but in the moment, it's very emotional. I know, looking at two different stories between the trade war and then the pandemic elevated prices, you had two very different trends there. And so it's two very different marketing challenges to meet. One's trying to stay away from those lows, and another one's capturing those highs. So what's that like, I guess?
Yeah, so the hardest season I've ever had in terms of marketing grain was COVID. That was a very challenging time. The trade war, it largely, worked into the marketing plan I had established from the standpoint that that's why we do it, right? Like that was why we did it. COVID was a little bit different because we weren't sure how long this was going to last. We didn't know if this was going to be 2 weeks and we would all be back, or if this was going to, last however long, the 16 months, what it was doing in other countries. There was just a lot that was unknown about that time that really changed things. But certainly, back to this emotion and this concept of emotion, it's really easy for market analysts, economists, extension economists like myself to sit here and tell people what they should do. I've always just felt like, man, that's a really insensitive thing for me to say, because it is very emotionally driven. And so I always encourage people, spend a little time and think through what you're doing and have a reason that even if it doesn't work out, if the market, moves opposite of what you're trying to do, that you understand, hey, I'm okay with that decision because I recognize that risk up front. And I knew that if that were to happen, these other provisions would be in place to help, or maybe I could get some support here. But I think that's where we really get caught up, is this notion of that there's a set cookie cutter outline that we need to follow. And I would certainly say that every plan and every person is going to have a different strategy because of the the emotional component of this, but also, and certainly in terms of when they need uh, you know, maybe product to move. Maybe they don't have on-farm grain storage, so they have to treat things a little bit different from a storage perspective. And then certainly this year, there's no incentive in the market to hold grain, or especially those old crop corn or those old crop supplies. Plus interest rate. Even if you had old crop in the bin, those interest expenses continue to increase, disincentivizing storage. So again, those are market signals saying, hey, don't store grain. And there's a lot of those, right, that we could talk about, that I encourage people to think through. Why am I doing this? What's my risk associated with this?
Well, and I think you make an excellent point there. Everyone's situation's a little bit different. And I know sometimes within farming, people can get caught up in, oh, my neighbor's doing this. Should I be doing this too? And I think that can be a slippery slope whenever you see, like you say, different storage, situations, maybe different production situations, even from neighboring farm to neighboring farm, depending on weather patterns, depending on luck and things like that. So it can be kind of dangerous if you're trying to base what you're doing off of what everyone else is doing too.
That's correct. Yeah.
So before we run out of time here, I want to go take a little bit of time to go over basis, just a brief explanation of basis. So really, it's kind of a mix of transportation costs between areas, but there's a lot more to it than that. So can you dive into that for me, please?
Yeah. At a simple level, basis is really just your local elevators or local buyers controlling the supply of grain in and out of those markets, right? That's kind of in a basic sense what it is. I always have said, and I continue to say this, that basis is probably one of the most important components of grain marketing, and yet it is probably the component that producers and even end users know the least about. We track cash prices, but we don't break that down into futures and basis. There's some places out there that report daily basis to their producers, especially new crop basis, and that's a great service to producers, because that basis contract tells you really which contract, if you're going to look at early season grain marketing, what type of tool to use. Is that a hedge to arrive? Is that a basis contract only? Is that a futures contract only, right? That's a great signal. And I think basis is really important because it tells us a lot about our local area, the supply and demand picture in our local area. But then it also plays in a big role into those grain marketing plans in terms of the tools to use.
So definitely something we should probably talk more about in the future, but really for now, well, looking to the near future, near term, what should farmers and ranchers really be watching? What reports, what things might be moving the market this next week?
Absolutely. So Wednesday of this week, we have our ethanol report at 9:30, and then the National Oilseed Processors Association will release their January estimates for soybean crush at 11 a.m. Thursday, ag export sales. Friday, the 17th, is the Commodity Futures Trading Commission report at 2:30, and then Monday, just as a reminder, next Monday is a federal holiday for President's Day, so the markets will be closed and everything will be delayed a day next week.
Yeah, I do enjoy those NOPA reports, though. It's always.
I do too. It's interesting. A couple of things, if I can take a couple of seconds here.
Yep.
A couple of things I'll be watching for is that soybean oil extraction rate. We saw that rebound in January. It's still low, not near as low as what it was in January. We've seen slightly fewer bushels being crushed for soybeans, even with those low extraction oil rates, compared to what we would have anticipated. And then of course that soybean meal market, I think, is really just continuing to create incentives for crushers to crush. And we've maybe swung that pendulum back to where, yes, oil values are high, but we need crush values for the soybean meal component.
All right, Ben, it's always a pleasure having your insight. Listeners, viewers, if you'd like to learn more about what we do or our sister program, the Weekly Livestock Market Update, you can do so at brownfieldagnews.com. I'm Will Robinson on Brownfield.